Well, as each and every day, we are tracking your markets here on this Thursday, and the corn market still holding on to about 1/4 cent gain here. The March corn contract is up 1/4 at 3.74 1/4. So is May. July is steady, but September is up 1/4, and that new crop December corn contract is up 1/4 at 3.99 1/2. Now, it is important to point out here that December contract did get as high as $4.75 for a high, and so we're not quite to that $4 threshold yet. We have pushed above it at one point. Whether or not we'll be able to hold on to it just above $4 remains to be seen. Let's go find out what's going on in the soybean market. We're back to the higher side here with March up 1, 8.95 1/2, May up 1 also, and September up 1/4 at 9.29 3/4. Now the wheat market got off with a little bit of a weaker start, which was opposite of where it was at last night on the overnight trade. March Chicago wheat leading the way lower, down 2 1/4 at 5.10 1/4. New crop July down 1 3/4 at 5.21 1/4. March Kansas City wheat down 1/4 at 4.95 1/4. July is down a complete penny. It's trading at 5.16 1/2. March Minneapolis wheat down 3/4 at 5.64 1/4. The new crop July is down 1 1/2 at 5.75 1/2. Now that December cotton contract is the new crop cotton contract. It is up 26 points at 74.50, but the nearby March is up 32 at 73.59. At the edge of the trading floor in Chicago with Prosper Trading Academy, it's Scott Gecas here with us. How are you doing today, Scott? Good to visit with you. First of all, this market here, this grain market, is it more of a weather market or a technical market or a fundamental market, or is it a little bit of all three right now?
Well, it's a little bit of all three, and that's why you're seeing the option volatility be a little bit elevated, anywhere between 1 to 3.5%, just depending on which market that you're looking at. For the corn and soybeans, the more active options are to the put side, to the downside a little bit. And as far as the wheat goes, you're looking for a little bit more upside calls being traded. The 820 calls have been a little bit active this morning. So with the fundamentals, all the headline risk, the government shutdown, with the lack of the reports coming out, traders are looking for something to trade off of. So it's just a wait and see, react to the headlines coming across, the fundamental aspect as well as the headlines. I mean, they all play a very significant factor here, as well as the weather right now. So traders are pretty much just in a wait and see mode, focusing on the options with the expected moves. Corn right now has an expected move of about, it looks like about 6.5 in the next 8 days. For soybeans, you're looking at a 16.5 point move in the next 8 days. So that's what I mean by the option volatility being a little bit elevated according to historical vol.
What about affordability of this options market?
Well, that's the thing. Because the option volatility is elevated, the premiums for the options are going to be a little bit more expensive.
All right. Has all of this uncertainty done anything with trading volume at all?
It really depends. So when you had that big spike lower in the soybean and the corn market, you've seen an expected open interest, increasing, volume increasing on those spikes. But over the last 2 days, you're seeing some consolidation, so the volume is decreasing a little bit. But the option volatility is still staying elevated, even with the lower volume within the last 2 days.
Okay, Scott, don't go anywhere. When we come back, we'll talk about the livestock trade after we check out what's going on in the futures. That's coming up straight ahead. So stay with us here on the Market Day Report. Let's get started over here in the livestock futures. Livestock futures market started out with weakness here today. February live, all the way across the board, by the way. February live cattle down 98 at 126.85. April at 127 even, down 72. The June down 58 at 116.92. Now, earlier in the morning, we dropped to 116.85 over here in this June live cattle contract. Did come off of that a little bit, but now we're down under that 117 level again. January feeder cattle down $1.70 at 142.07. March feeder cattle at 143.65, down $1.05. And the April down 83 at 144.72. Rest of those contracts also in the lower category. But we're starting to see a little bit of a shift over here in the lean hog complex, with February up 43 at 60.48. April down 17 at 64.90. Now changing now 64.95. May down 3 at 70.80. But June and July are offering us a little bit of a mixed bag here this morning, pushing things just slightly higher. Let's go back to the edge of the trading floor. Scott Gecas rejoins us here. And first of all, Scott, what do you think of this cattle market? I saw this morning where we've got some packers bidding 120 plus in the south, 197 in the north. Still no cash cattle trading.
Yeah, everyone's waiting on that cash cattle trade. You know, with the last 3 out of 4 days hitting new contract highs, straight up, the trend is definitely to the upside. Volatility right now with the cattle market is about 30% higher than normal. Now, the one thing I want to point out is when you look at the option volatility as far as skew goes, usually when you look at options, you price things to the downside. The skew is always mainly going to be to the put side. However, with commodities, with physical assets like cattle, your skew is going to be the upside because cattle's never going to go to zero. It's not going to go bankrupt like equities. So you have a reverse kind of skew. So right now with the cattle market being at contract highs, that's why you're seeing the increase in volatility, and it's definitely to the skews to the upside calls. You're seeing a little bit of action in the 130 calls with the cattle market.
Pretty interesting stuff. What does it do then for the hog market?
The hog market is very odd right now. It's a different place because of the African swine flu affecting all the world pork. So yesterday when I was on, I was talking about the big spike lower where you had that put skew about 3 to 1, meaning that you're going to pay about 3 times much for the puts than you would for the same out of the money calls. However, coming in this morning with the consolidation over the last 2 days, that puts call skew completely flattened. So if you look at the 10% out of the money calls versus 10% out of the money puts, they're roughly about the same price. So that flattening is what that tells us as far as the technical chart goes, is that it's in a consolidation period waiting for those exports still to show up from China.
And I'm glad you went down that road. Further consolidation ahead, do you think?
In the meantime, yes. Until we get something of headline coming out one way or the other, I think you're going to see a little bit of a sideways move in the hogs.
Wow, great insight here. Scott, always good to visit with you. Scott Gecas there at the edge of the trading floor, and he is with the Prosper Trading Academy.